it's Katya and welcome to my channel. Today we are talking about something that can potentially save you a lot of money when selling your business or investment property, and that is 1031 exchange. So let's get started. So what is 1031 exchange? When selling a business or investment property and you have a gain on it, you will have to pay a capital gain tax on the gain of the sale. Now, there is a section 1031 of Internal Revenue Service that allows you to defer the payment of taxes on the gain as long as you reinvest the proceeds of the sale into a like-kind property. Like-kind property doesn't necessarily mean if you are selling a warehouse, you will have to buy a warehouse as well. No, the value of the property, the replacement property that you will be buying will be at least the same as the sale of the previous property or greater. So in other words, only like-kind exchange can be tax deferred. The taxes are not forgiven, they are deferred. And the taxes are going to be due if let's say in the long run you decide to sell the property and keep the proceeds to yourself. So there are many types of 1031 exchange, but I will discuss the most common one. And the first one is delayed. So the first property is sold, the first or relinquent property, and the second or replacement property will be purchased within a specified time frame. Second kind is simultaneous, which means that the first or relinquent property is sold and the second property or replacement property is purchased at the same time of sale of the first property. The third type is delayed reverse, which indicates that the second property is purchased before the first or relinquent property is sold. The fourth kind, it's delayed build to suit, which indicates that the second property will be built to suit the need of the investor. And the fifth kind, it's delayed simultaneous build to suit, which indicates that the second or replacement property will be built to suit the investor needs even before the first or the relinquent property is sold. The process of 1031 exchange is very specific, and you cannot simply sell the first property and buy the replacement property. Both of these transactions have to be a part of one mutual process. Once you sell the first property or relinquent property, you have 45 days to identify few different potential properties and make sure that either one of those qualify to be participating in 1031 exchange. So that is the first important time frame, 45 days from the sale of your relinquent property. Now, once the property is sold and closed and the replacement property is identified, you have up to 180 days to close and take possession of the replacement property. Everything must be in writing and signed by everyone, and the possession of the property must be taken by day 180 from the day of closing on your relinquent property. So while the transactions are taking place, the funds that were received from the sale of the relinquent property are not going to be given to the investor. The funds are going to be held in an escrow account by an intermediary that is basically helping you out with this transaction. So now let's talk about steps that you need to take if you decide to proceed with 1031 exchange. First of all, you will have to find a qualified and knowledgeable professionals that will be able to assist you with this transaction. And the first professional is an intermediary who will be assisting you with the transaction. The second professional is a tax professional. Make sure that you have a great CPA who will be able to count all of the bases of the relinquent property and the replacement property. Now you will also have to find a professional and qualified lawyer and professional and qualified real estate agent. So before selling your relinquent property, you have to make sure it does qualifies for 1031 exchange, and then hire a qualified intermediary who will assist you with this transaction. Now, once the property qualifies and you received your first offer and about to get a contract on a relinquent property, you have to make sure that you add a relinquent addendum to it, because this addendum basically shows that you are intending to proceed with 1031 exchange, and that is very important. Once you sign a sales contract on the sale of your relinquent property, you have to provide your intermediary with this contract. So once the closing is done on your relinquent property, you have 45 days to identify your replacement property and make sure it qualifies. You can choose anywhere from 3 to 10 different properties and make sure to provide your intermediary with the details about these properties so they can help you and guide you through to make sure that those properties or any of these properties do qualify for 1031 exchange. Once you made your decision on a replacement property and you have signed a sales contract on it, make sure to send your contract to an intermediary so that he or she can proceed with the transaction. As well, important documentation that have to be signed, it's an assignment contract. It identifying a replacement property as a replacement property in a 1031 exchange transaction. Now remember that you have 180 days from the closing of your relinquent property to take possession and sign all of the required paperwork for the replacement property. Now, the last step is filing a 8824 form with the tax return. An important part is this form has to be filed with the tax return on the year that the first property was sold in. So for example, if you sold your relinquent property in 2020, you will have to file an 8824 form in year of 2020, not in 2021. So what are the benefits of 1031 exchange? Well, first of all, you are not paying capital gain taxes. Just as a side note, capital gain taxes, depending on the state you are performing it in, can be anywhere from 25 to 40% of your profits from the sale. And those funds will be covering state and federal taxes and depreciation recapture. Another great benefit is upon your death, your heirs will receive this property revalued and all of the capital gain taxes that you deferred will be eliminated. So if they decide to sell this property, they will be paying no capital gain taxes. Another benefit is that you keep receiving proceeds from, let's say, rental of your 1031 exchange property, and those proceeds in the future can be pulled, the equity can be pulled and used for anything, for example, for remodeling, for improvements, even for a college tuition. But make sure to verify that with your tax specialist. Another great benefit is that if you are, for example, buying a rental property, in 5 years, as long as you hold this property for 5 years, that property can be converted into your primary residence. So if you're looking for something on, let's say in Florida, Naples, Florida, some great retirement home, you can buy this property, rent it out for 5 years, and after 5 years, you can convert it to be your primary residence. Additionally, it doesn't matter how many properties you exchanging in or out. For example, if you had one property and you exchanged it into 7 properties, or you had 5 properties and you exchanged it into 2 properties, as long as the value, combined value, is the same or greater. Now, you do not necessarily have to buy within the same state. Majority of the times, 1031 exchanges are done in different states. Even more great benefits about 1031 exchange and its closing costs. As long as closing costs are identified as a normal transaction cost, they can be paid for from the proceeds of 1031 exchange. But on the other hand, the non-transactional expenses will be taxed. So for you to better understand, let me give you a few examples on what will be qualified as a normal transactional expenses and what would not. Let's start with normal transactional expenses. First of all, a sales commission will be identified as a normal transactional expense. Second, pretty much anything that has to do with your closing. For example, origination fees, lender fees, legal fees, recording fees, doc fees, settlement fees, exchange fees, notary fees, processing fees, property tax. Those are considered to be a normal transactional cost. Now, what cannot be approved and will be taxable if you will be using proceeds towards this closing cost are utilities, discount points, mortgage insurance, liability insurance, homeowners association if there is any in place, lender's title insurance, acquisition fees, any repairs or the termite work, assumption fees. Security deposits and acquisition fees are not considered to be a normal transactional cost. On the other side, inspection and appraisal fees might qualify. It all depends on the transaction, and your intermediary will be able to assist you with determining if those closing costs are qualified or non-qualified. So summing up, a 1031 exchange, it's like a gift from IRS to you, and the funds that you are deferring can be used towards your benefit immediately. Additionally, if the property that you did a 1031 exchange on are put in trust and your trustees after your death will be reselling the property, they will have no capital gain tax. The capital gain tax will be eliminated and the property will be revalued to a current market value. Thank you so much for taking time to watch this video. If this information was useful for you, please click thumbs up and subscribe button so next time my video comes up, you will be notified. If you have any questions, please feel free to reach out to me and I will be more than happy to assist you. Thanks again for your time, and you folks have a great one.